Good morning to you all and welcome to our Wealth Report launch. I'm recording this from home the day before the launch of the Wealth Report film, which we're excited to be sharing with you shortly. If you would like to contact any of the presenters from today's film, please use the contact details to the left of your screen. If you have any questions on the ideas we discuss, please submit a question below and the team will respond directly. And finally, you can download a copy of this year's report using the download button on your screen. It goes without saying, however, that in the face of the unfolding humanitarian disaster in Ukraine, how markets and economies fare is, of course, of little relative importance. However, given the current crisis, we all need to be aware of rising risks. Aside from growing geopolitical turmoil in Europe, COVID, inflation, wealth inequality, and environmental issues continue to provide immense challenges, all of which we address in this year's report. I hope you enjoy the film and find the content both interesting and useful.
I am delighted to welcome you to the Wealth Report 2022. This is the 16th edition of the report. We are thrilled that you can join us today for the global launch of our flagship publication, aware that this is the second edition of the report to be produced against the backdrop of the COVID-19 pandemic. Today, I'm talking to you from one of the private terraces of the Bryanston, an example perhaps of why London's global supercity status endures. Designed by renowned architect Raphael Vignoli, this remarkable 18-storey building has 54 prime residences with, in my opinion, almost unrivaled views over London and Hyde Park. Today's launch is straight talking, global and only 30 minutes long. Please do go full screen to enjoy the benefit of the presentation. This is our opportunity to present to you once a year with our thought leadership and insights on private wealth, prime markets, evolving trends and opportunities. I cannot remember a time where the world of private wealth is evolving as quickly, given the times we live in. The findings in this year's Wealth Report, therefore, feel ever more relevant to understand the performance of real assets and, crucially, our outlook in tomorrow's world. There are some clear takeaways for me. Firstly, we've witnessed a wealth surge on the back of an economic rebound, with the number of ultra-high net worths significantly increasing despite the pandemic and uncertainty. Secondly, the pandemic has seen many private investors increase their allocation to real estate. Notwithstanding continued travel restrictions, our clients want to be more rather than less global. Cross-border investment is on the rise, as is the number of our clients looking to relocate and invest overseas. The impact, of course, will be felt in prime property markets around the world. And finally, widening the lens and looking at the big picture now feels like a pivotal moment for private wealth. Yes, wealth creation has continued apace, markets have ascended to new heights, and opportunities abound. We are excited, however, to see that the pandemic has spurred innovation across both the digital world and the property sector. Change is afoot, so now feels like a good time to be well informed. With that in mind, and without further ado, let's dive into the key findings of this year's Wealth Report.
We've got some really interesting and dynamic areas in this year's report.
The world is changing. We're at a pivot point.
The big story for 2021 was the sheer amount of wealth growth that we saw.
ESG is a very important consideration for investors.
Blockchain is powering huge new investment opportunities.
The rules around housing market economics have been totally upended.
You can't look at wealth creation in a bubble. You have to look at the wider picture. And when you look at the wider picture, risks do start to emerge.
The global economy drives our story, and this year it's been remarkable. The global economy expanded by 6% over the past 12 months, and in terms of our results, that's driven wealth creation to new highs.
So last year, the number of ultra-high net worth individuals around the world increased on average by 10% despite the pandemic.
So 52,000 more very wealthy people investing and spending globally. And that's really driven all of the narratives in this year's report.
We haven't seen that level of wealth growth since 2017. We saw a huge amassing of savings as people didn't go out and spend in restaurants, they didn't go on to holidays. So all of this was an accumulation of wealth. So people are taking that wealth and they're able to invest it into stock markets, equities, property, many different types of assets.
If you're lucky enough to own any kinds of assets, you did very well in 2021.
Property markets have been absolutely the epicenter of the disruption that the pandemic caused. Themes like working from home, where people are, how they're living, how they're working, disruption to shopping, lockdowns, etc. All of those things have been a big challenge to property sectors, but actually for investors and for entrepreneurs, it's been a massive opportunity.
One of the key stories of the past 12 months has been the rapid rebound in commercial investment activity generally. We saw over $400 billion of private capital invested over the past 12 months, which is an unprecedented level. Most private capital is invested in sectors like offices and retail, but the big change has been that there's been this really large increase in demand for logistics, sectors like healthcare, data centers, life sciences, all sectors which are really there to capitalize on the growth and the changes that we're seeing in the economy.
The standout story really was that movement of wealth into prime residential property markets. Our Prime International Residential Index, which benchmarks 100 markets around the world, saw record performance. So we saw 8.4% growth year on year on average. And that's the highest on record that we've seen since 2008. So really phenomenal growth. We've seen a lot of a reassessment of housing need from a number of wealthy individuals as they sort of no longer tethered to the office. They can now potentially move further away, and that's had a big impact on demand. The Americas was the top performing world region. We saw on average markets there increase by nearly 13%.
I mean, an interesting one for some of our readers might be London. It's seen growth. The prime market is up 2 or 3%, depending where you are in the city. So it's been a slow market over the past few years, and this last year has seen the first turnaround. Suddenly we're seeing positive growth. It isn't rapid, but it is certainly an increase in confidence in the market.
We've seen renewed interest into commercial sectors that have been hit hardest by the pandemic. So be that offices, hotels and retail. There's certainly investor demand beginning to come back into the retail sector, looking at assets that have been rebased.
Offices are still an incredibly large, incredibly important part of the global real estate market and even the global economy. People are reevaluating the kinds of product that they want to invest in, selling out of some, buying into others, and it's becoming a very, very active marketplace again.
Commercial markets, especially driven by private capital, have been growing very strongly. But perhaps to me, because I also compile the Knight Frank Luxury Investment Index, which tracks the value of luxury collectibles, that's where we've seen some really interesting trends over the past year, particularly in what people are calling crypto assets, NFTs, digital art. And that trend has just continued. I mean, we have seen over $60 billion invested in these NFTs, these non-fungible tokens, this digital art you can't even hang on your wall. So I think actually the extent of that has surprised me. In terms of performance, these values are increasing hugely across the luxury collectibles scene. Wine, art, watches, all increasing by around 10% or more in 2021. You have to look at the wider picture, and when you look at the wider picture, risks do start to emerge. Although wealth has increased vastly around the world during the pandemic, wealth inequality has also increased.
In the Taxing Times article within the Wealth Report, we point out that actually wealth inequality is at its highest level on record. And within the attitude survey, we ask ultra high net worths what they think are the biggest threats to wealth accumulation. And 42% cited that they felt that wealth inequality was a big risk.
One of the biggest risks that our clients point to is actually the sheer growth of wealth itself creates a risk in terms of reaction from governments through taxation, for example.
Tax and regulation is one of the top threats identified by our attitude survey respondents. 70% saw it as a threat, and taxes and regulation are coming down the track. Governments have amassed huge deficits during the pandemic. That hole is going to have to be filled by something.
This year, Kate Everett-Allen talks in our residential section around cooling measures and taxation in property. And we're already seeing this, particularly in locations across Asia, but aimed very much at the top of the marketplace and seeing it as an opportunity to raise tax from wealthy purchasers and wealthy buyers and having a side benefit of restraining growth in the marketplace.
We've already seen in 2021 taxes rise in places like Singapore, but what we're expecting is that that will be a trailer really for the main show which will take place in 2022 and perhaps 23 as we see more tax and regulation come to the fore. Certainly we're going to see a push for greater transparency. We've seen that in the EU in terms of residency and citizenship initiatives, really trying to get a handle on what money is coming into those markets, and I think we'll see more of that globally. We know that a number of policymakers are now looking closely and at potentially new ways of trying to tap into taxing wealth to curb price inflation over the coming years.
One thing that really stands out above all else, and that is inflation. We know we're moving into a higher inflation environment. We know rates are going to rise. And the question really on investors' minds is how quick is that process?
Inflation is dominating headlines and dominating investors' worries and concerns. 70% of survey respondents said that inflation was one of their top concerns this year, and investors need to consider that and guard against it, whether that's looking more towards property or other assets.
We're seeing families diversifying portfolios from a wealth preservation perspective. Because of the rise in inflation, we will certainly see families becoming more focused on income-generating assets.
What we would say is that the right type of real estate can be a very effective inflation hedge, and so we'd expect to see investors looking carefully to see if they can utilise real estate in their portfolios to mitigate some of these risks that they perceive.
The ramifications of inflation, what that means for asset classes, I think that is going to be the big story of 2022.
We touched on ESG in depth in last year's report. It's become ubiquitous as an investment theme, and the property sector is absolutely kind of front and centre of this debate.
As many of the family offices move now into perhaps the third, fourth, or even fifth generation, we start to see younger members of the family coming up into decision-making positions, and therefore they have a very different attitude to perhaps to their parents. They might have a different risk profile. They are certainly more focused on ESG and environmental impact as a whole, and also in terms of environmental impact from an investment perspective.
What we've seen over the past year with the survey is that where a year ago responses were that there wasn't enough information or that the data was hard to come by, that's less of an issue. The big issue now is finding the stock in which to invest in. The reality is that buildings that meet certain ESG criteria can generate a higher return for investors. Now, if you want to invest into those assets, often that entails paying a slightly higher price, but in doing so, you're safeguarding your return, you're future-proofing your investments.
What we begin to look at in the report is actually just thinking this through. What happens when governments get real about actually, or begin to really kind of shift into gear to actually meet their Paris commitments? Because at that stage, you get into a much deeper debate about actually the level of change that's needed, the level of change, the level of disruption that is coming to all of our sectors. points to some really big opportunities, and actually the level of investment, the level of innovation that's going to be required to meet the challenge is only going to get bigger.
So in the Wealth Report, I was lucky enough to interview the CEO, Hannah Jones, of the Earthshot Prize, which is Prince William's initiative to identify entrepreneurial talent that can make a real difference to solving some of the big issues facing the world at the moment. What's really interesting about Earthshot is actually it's hooking up some of these entrepreneurs with actual capital. For example, Michael Bloomberg is one of the supporters of Earthshot. He'll be using his expertise to actually develop some of these ideas that are going to combat some of the big issues facing the world. And I think in the rush, the clamour to have an ESG tag on your investment funds, those are some of the opportunities that I really think that the world is going to be missing out on.
The progress that we've seen in ESG and in investing in sustainable ways is incredibly positive, but that doesn't mean there's not more to do. There's still a lot more that investors can do to help drive this agenda and help make investing in real estate a more sustainable venture. We've always been big believers in the globalisation of real estate as an asset class over the longer term. And as we look to the year ahead, we think 2022 is going to be a record year for cross-border investment activity in real estate.
We've seen a lot of talk about regionalisation and deglobalisation, but that's actually not the case. What we saw last year was record levels going into the port of Los Angeles, record shipping levels going through the Suez Canal, despite the fact that it was blocked for 6 days at the beginning of 2021. Globalisation is on the rise.
So in the attitude survey, we ask the question, how many people are looking to move country over the coming year? And that figure's around 36%, so it's relatively high, which would suggest that sort of cross-border flows is going to continue.
We've seen record levels of exports of goods over the past 12 months, and it's echoed in the amount of money crossing borders into commercial property and investment property. So we've seen record levels of investment into the Americas, into Europe and into Asia. Again, a lot of that is cross-border, and actually the rate of growth there isn't slowing. If anything, it's accelerating.
A full 60% of our attitude survey respondents cited blockchain as an increasing opportunity. We're seeing tokenization now coming into the real estate sphere. In recent weeks, there has been a large institutional investor potentially looking at actually tokenizing real estate now. So we could see that opening up property investment to a much bigger audience. That means more capital targeting property. It's something that we're seeing a lot more ultra-high net worths go into. 18% now own a cryptocurrency or crypto token of some sort, according to our survey. 11% own an NFT. So there's a huge amount of wealth now going into the space, but there's a lot more room to run.
People are paying hundreds of thousands of pounds for blocks of virtual land that they're going to build shops on, or even the Bahamas now has an embassy in a metaverse. Virtual assets are now more important to some people than physical assets.
It's not a binary choice of physical or digital. There will be that overlap, and the opportunities there is incredible. We talked to some experts in the report, those particularly looking at retail spaces, because this is where a lot has already happened in the metaverse. We've got many luxury goods companies who have digital presence. We're seeing whole new industries pop up. Digital architects, these people who are building games, they're building homes, they're building anything you could even think of in the metaverse. There's the idea that you can interact with so many more people. In the physical world, you can only interact with who you're physically next to or who you're physically seeing, and you can only show them your artworks when they come and visit you. Whereas in the virtual world, the possibility for interactions are almost infinite.
The digital economy might seem intangible in some regards, but actually these are the same companies that are taking office space in some of our most prestigious buildings. They're the same companies that are driving demand for data centres.
So the virtual world is something, if we don't understand it at the moment, we do have to understand it pretty quickly, because it's here, and that's where a lot of the investment opportunities are going to be.
In 2022, I think we're going to see prices still continue to rise across most markets. I think the housing boom that we've seen to date will endure. Top of the rankings in our forecast article are Dubai, Miami and Zurich. We expect all three markets to see growth of around 10 or 12% in 2022. The extent to which the normal rules and laws around housing market economics have been totally upended. And I don't think we're going to see a return to normality until we start to see those levels of supply starting to come through again. There's a lot of savings that have gone unspent, and there's a lot of demand still filtering through as borders start to reopen. Yes, in Europe, things are largely starting to get back to normal, but there's other parts of the world where that demand, that pent-up demand, is still sat there waiting to be accessed.
Well, one of the big opportunities for investors over the course of this year is to really tap into the economic growth that we're expecting to see take place. So that means investing in sectors which are growing, some of the newer sectors, life sciences, technology-led, data centres, etc. But also in those sectors that are poised to benefit from a return to work, offices, types of retail, leisure and hospitality.
We're starting to see demand trickle back into cities as people realise they've missed out on the culture and the richness that the urban living offers. So, for example, in the case of New York, the market there is really bouncing back quite strongly. Just in Q4 of 2021, we saw the highest number of closed sales for 30 years. So really strong demand coming back to the city there.
What I think is really interesting is that the leading auction houses of the world have cottoned on very quickly to this digital world, and they're actually curating their sales to reflect that. So they're mixing digital art with more traditional art. They're bringing in asset classes like sneakers, things from contemporary culture that perhaps weren't collected before. So I think we're going to see a really interesting hybrid world of luxury collecting starting to emerge.
As investors look to the next stage of the recovery, they should be thinking about the needs of businesses as they expand and the kinds of business space that they need. There will be a large and growing demand for new space and different types of space that really can accommodate the different ways of working that we're all looking to embrace as we go into this recovery.
The number one sector that investors are focused on over the past 12 months and actually over the coming 12 months is the office market. That's where the majority of money is moving to. And this is at a time when we've been in lockdown, people have been working from home. I think it points to two things. One is the fact that there's a recognition people will go back to the office. There's a benefit from networking, training, collaboration, etc. But also a real recognition that actually the world's office estate really isn't fit for purpose, and actually the opportunity to improve properties and the quality of accommodation is a massive opportunity play for investors.
Our survey respondents were the most optimistic for next year's wealth creation than they have been for the previous 5 years in which we've asked the question. 83% expect their clients' wealth to increase next year, so that just shows the sheer scale of opportunity out there for wealth growth and investment.
Hello, I'm Tim Hyatt, the head of the UK residential business at Knight Frank, and I'm delighted to be able to conclude today's proceedings. First of all, I wanted to share my thanks to all of our team who contributed to this, the first glimpse of this year's Wealth Report. The narrative that the report covers, from economic and wealth expansion to rising risks and opportunities across our key markets, is critical reading for everybody involved in residential and commercial property markets across the globe. The report itself is now live, so please be ensured to download your copy below and explore the extensive content and insights that are available online. If you would like more immediate response to any questions that you have, Rory, the private office, and all of our teams are on hand to discuss your next steps as you plan for the year ahead. So please do contact them and see how we can help you. You can find any of the speakers' contact details on the screens below. I would also like to take this opportunity to thank the Knight Frank Global Business for supporting and contributing to the creation of this year's Wealth Report. This publication, in my mind, truly demonstrates the breadth and reach of Knight Frank's network and our unique strengths across both the commercial and residential markets. And finally, I'd like to thank you for your continued support as our valued clients and customers. And all it goes for me to say now is I wish you all a very prosperous year ahead.